impact on markets and maybe some things that you need to know as an investor to be successful, especially right now with kind of in the middle of this craziness. So to accomplish this goal, I am super excited that we were able to welcome an expert guest, Dr. Apollo Lupescu. He is a vice president with Dimensional Fund Advisors. He is been nicknamed the Secretary of Explaining Stuff. I've actually had a few occasions to listen to Apollo, and the thing I really appreciate about him is how he's able to take complex subjects and make them much more simple. I always come out of it feeling way more clear on my thinking. I'm very confident that he's going to help you with your perspective as well. So without further delay, I'm going to go ahead and bring Apollo on right now. Apollo, thank you for joining us today.
Thank you so much, Kendall, for inviting us, and thanks to everyone who's taken time today to attend this webinar.
So Apollo, just to get things kind of started, we're seeing all kinds of craziness in markets right now. I can tell you that I've been in the industry for about 18 years. I started during 9/11, right after 9/11. Very scary time. Markets were very volatile, a lot of market losses. People got hurt. 7 years later, Great Recession hits.
Right.
Very worst bear market. I think markets were down over 50% from peak to trough. Worst economy we've seen, since the Great Depression. Very, very scary. Now we've had a pretty nice bull market, 10 to 11 years. Mm-hmm. We've come to this point with all the craziness in the markets and what the COVID-19 has done. What are we to make of all this? What's your perspective on what's going on with markets right now?
Well, I mean, you just walk through a series of crises that every time it happened, whether it was 9/11, whether it was the Great Financial Crisis, every time something like this happened, one of the sentences that I hear most often is that we have never seen anything like this. It's unprecedented, and it is different this time. And in every one of the instances that you mentioned, it was true. We had never been attacked on our own land. We had never been through such a devastating financial crisis, and then here is this new situation that we have to deal with. And I think that all of them had its similarities, but this particular situation, it is different than what we're used to. And I'll tell you why I think it's different. First of all, I think that it is not only touching us as investors, because we look at our statements, we look on the news, and it seems there's so much choppiness. Our accounts are down in terms of their value. So definitely there's the market component that we'll touch on. I think it's also important to acknowledge that this has created a very the tremendous time in terms of anxiety towards our own health and our family's health, because I can tell you, I have family members who are susceptible to this COVID-19, and in fact, I had two very close family members who were exposed, and they went through the coronavirus and the COVID-19. So it is impact personally on a more dangerous level, which is our health level, and that is something that's terrifying, because it's not localized like 9/11 was in New York. This is, or Pennsylvania or DC, which is a relatively small. This is across the entire country, so that's different. You also have the economics of it, and I think that I'm going to spend some time, because the economy shut down and it's different, and it doesn't look that things are likely to improve. At least right now, it seems like we're still in lockdown, and I think that what makes this different in a way from other instances like the ones you mentioned is that typically when there's a market downturn, it's a reflection of an economic situation, and typically the economic situation is categorized by economists as something called a demand side crisis. And what it means is that in the U.S. economy, there are three main categories of drivers of economic activity. You have consumers who are buying things, you have companies who are buying things, and so all the goods and services are being purchased by consumers, the government, or companies. And in a traditional market downturn, in the traditional economic downturn, what you see is that either one of these groups, consumers being the largest portion of this economic activity. So let's say consumers are spending less because either their unemployment went higher, or they're not feeling confident spending money, or something like 9/11 happened, or the financial crisis. And when that happens, they're not buying enough, so the firms are not producing enough. And the typical was, well, let's give some tax breaks to consumers, and then they have more money, they spend more money, and therefore the production rebounds and the economy goes back up. That's the traditional type of a downturn that we've seen. I wouldn't say often, but the average is on average, every 10 years, we see a type of this downturn. In that respect, we're close to the average of those. What makes us different is not only that we have a demand side, but we have something else called a supply side crisis. And in a supply side crisis, even if the economy would like to produce, it just can't. So think about this. You heard about the stimulus from the government. It's not a stimulus. Because a stimulus is looking to say, here's the money, go spend it. And by you spending it, the factories produce more, and that's not the case right now. Because even if you have the money and you're trying to spend, well, the economy is not producing because the workers are stuck at home. So today we have not only a demand side crisis, but also a supply side crisis. And that is not something that happens very often. In fact, looking back through my economic history books, it turns out there are only 3 instances that I can recall in the last 100 years or so when we saw both a demand and a supply type of crisis. And the first one was actually exactly 100 years ago. None of us, most of us actually, I would say the great majority of us were not around. And even if we're around, probably too young to remember. But exactly 100 years ago, there was something that we know now as the Spanish flu. And the Spanish flu was a pandemic very, very, very similar in many respects to what we're going through. And the reason it's called the Spanish flu is because when it started, we're in a war, World War I. And most press across the Western countries, they had censorship and they were not allowed to report on this. But there's one country that didn't, and that was Spain. And everybody read about it in Spain. I was like, well, it must be the Spanish flu. But in fact, nobody knows precisely where it started. I think there was an inkling that it might have started on a military base in Kansas around March of 1918. And I know it seems like a lifetime away. And it's so true that the medicine has evolved, the society has evolved. But what's interesting is that the way that the economy and the way that the government responded to that is, in a way, eerily similar to what we're going through right now. If you go back and you ask, what do we do to try to get rid of it? The one thing that they used back then, it's exactly the same thing that we are using today. It's incredible that the playbook is almost identical. And what it was is like, let's shut down the economy and let's go into social distancing. I don't think they call it social distancing, but it's exactly the same idea. Churches were closed, schools are closed, theaters are closed, all indoor activities or meetings were forbidden. And in fact, people were required to wear masks on the street, pretty much like today, and to enforce, they even had policemen in masks just going out there to enforce this. So it is, it's remarkable to see that we are going through exactly the same thing that our grandparents did 100 years ago. Nothing different. It's a different virus, but it's pretty much the same. And what's instructive when you look at these periods is how we dealt with it and what came out. So how we dealt with it, there was a paper published maybe about a week ago or 2 weeks ago by two Fed economists and a PhD from MIT. And what they wanted to know is what it took to solve this crisis from an economic perspective. And the overwhelming answer in that paper is that you need to solve the health situation before you can address the economic one. And in those days, the cities had the latitude to impose different lockdowns. And at the short end, some cities went into quarantine for about 60 days, so 2 months, and some all the way to 120 days, which is 4 months. And what this paper looked and found very clear evidence is that cities that responded early and they stayed in quarantine longer ended up economically a lot better off than the cities that responded late and that had a shorter quarantine. In other words, what you hear on the news today about it's a trade-off between the economy and health, that's actually the evidence is not in line with that. The evidence is actually quite the opposite. It's saying that if you take care of the health, you will take care of the economy. If you don't take care of the health, you won't take care of the economy. So it's a lesson for us today that we do need to take care of the health crisis and be careful not to do it too early. And there is good evidence. So to me, we're going through some of the same things that they did. And obviously, you ask, well, what happened afterwards? Well, I can't give you play-by-play. There are not that many economists in those days collecting data, but I can tell you that anecdotally, I know exactly what came afterwards. It was the Roaring 20s. It was the Roaring 20s. That's what happened. And then soon enough, what you had is that you had, people congregating in bars again, and certainly just kind of relaxing and enjoying a drink. You also had manufacturing that stepped up big time. You had cities that now became modern, and overall, we went through a really, really good period. In fact, as a decade, it was probably one of the best decades until towards the end in terms of economic development, socially. A lot of things that were really stellar about the 1920s. So we did go through it 100 years ago. When we came out of the back end, there are differences from today for sure. But at the same time, you look and see that the society rebounded, and it was actually quite a good period. That's the first time, the Spanish flu in 1918. The second time we saw this was during World War II, because during World War II, what happened was that you had about 11% of the workforce being drafted to participate in the war effort. So 11% of the workforce just gets pulled off. And obviously, you can't produce the same amount because you don't have these workers. The 11% is just basically sent off to contribute to the war effort. So a lesson for today is looking at how we innovated, how the spirit of the society allowed us to go through it. So what did we do to make up for that lost 11%? One of the things that we did was basically involve women into the workforce and to a level where it kind of gave everybody a really solid feeling that whatever job a man can do, so can a woman. So that spirit has gone further and further, and we're not there yet at all. Like to kind of say we solved it, we just inched along the way to make sure that everybody understands that everybody can do everything. It doesn't have to be a job for a man or a woman. And so we went there and we solved it somehow. The same way that today we are using technology to solve problems that otherwise might be like that would be really tricky. So we found a way. But there's another lesson for all of us that has to do with the basis that is still in place today. And that is the fact that back then, as well as today, we live in a capitalist world. And in a capitalist world, what dominates are free markets. And in free markets, companies will find a way to make money in whatever state of the world we're in. And back then, if they couldn't sell cars, GM made tanks. If they couldn't sell toys, they might have made bullets. That's exactly what you see today. Distilleries are not making spirits anymore, but they're brewing hand sanitizer. Ford and GM are basically repurposing their assembly lines to make ventilators rather than cars. So to me, it's exactly the same thing, that these companies will find a way to get through and make money in whatever state of the world. And even if you have today CEOs working out of their pajamas in the bedroom, the reality is that they're really sharp folks and they all want the same thing. I want this company to go back to being profitable. And it's remarkable how it worked back then. If you look at the market, so let's tie this a bit into the market in those years. In 1937, just as the world was getting a sense that this is not going to look good, the stock market dropped by about 35%. So almost as much as in the great financial downturn. 38, there was a rebound, but 39, 40, and 41 were negative years. So by the time the U.S. entered the war in late 1941, 4 out of the last 5 years had been negative in the market. And in fact, if you look at an average over these 5 periods, there's probably like a negative 7.5% in the market. And if you are an investor in a dimly lit living room somewhere in a small house, and you have the radio on telling you all the bad news, and on top of that, you look and say, boy, this doesn't look good. We're now entering a war. There are millions of people being killed. Cities are being destroyed. The 4 out of the last 5 years, I have lost money in the market, and quite significantly. We must be thinking that this is not a good time to be an investor. In fact, this might be a terrible time with everything going on. And what's incredible is that during the darkest days of our parents' generation, the market in the full years of war pretty much grew at a rate of over 22% per year on average. This is what the stock market did during the darkest days of our parents' generation, when everything was doom and gloom. The market somehow went up. It is because these companies will find a way to make it work in whatever state of the world we're in. So it's a lesson from there that is today with us, whether it's about participation in the workforce and being productive, either through women or technology, and also in free markets, being able to capture opportunities, whether it was back then or today. And the third time that we saw a demand and a supply shock was in 1973. There was a crisis in the Middle East, and to show their displeasure with the U.S. policy, the Organization Petroleum Exporting Countries, OPEC, they basically said we're going to stop sending oil to the U.S., and there was that oil embargo. And what it did, it pretty promptly created an oil shortage. And there were cars that would just be, piled up for long, long lines, and then people waiting hours in these cars waiting to gas up. And it was a big shock to the economy because we rely on that commodity. We can't take our kids to school. We can't go shopping for groceries. We can't go to work, let alone have all the economic activity. So it was a very big shock to the supply, and it did produce a downturn. But what are the lessons that we learned from there? Well, right after the crisis, one of the lessons we learned is that, perhaps we need to make a change. And the law was passed requiring better fuel efficiency for cars. And over time, we went from the gas guzzlers of the 70s to the much more fuel efficient cars of today. And that is a direct result of the crisis. The other thing that happened was, we finally realized as a country that we depend on a commodity that comes from other countries, which are not always friendly to us. And soon enough, that the idea of energy independence started to grow to the point where today we are the largest oil producer in the world, more so than Saudi Arabia, than Russia, than anybody else. And to me, it was a direct result of this idea that we need to take care and we need to look at oil not only from the perspective of a commodity, but also from a national security perspective. And what's interesting to me is to look at these lessons for today. It is quite possible that if we look back 20, 30 years from now, we might consider this the moment that triggered a change, that companies are not using that freewheeling supply chain from all over the world, but they're rather kind of saying, maybe that's not as reliable. And maybe we ought to consider not only the slightest of pennies in profits, but also national security. And this might be the moment of the rebirth of American manufacturing. Because again, it's not only about dollars and cents, but also a level of national security. And to me, it's quite possible that 30 years from now, this might be the legacy of this situation. The same way that 1973 was the trigger for the big change in the way we view oil. So it is something that we can learn from it. And the other thing is more of a personal thing. I live in Los Angeles, and it's been a pretty crazy few weeks being at home. And I love that. I mean, I love being with my family. The other thing that I love is that I can walk outside, and this is true. I live in West Los Angeles next to UCLA, and I was just walking the dog, and I look up, and there you go. There are some mountains there, a range of mountains that I knew they're there. I just had never seen them from my house. And they were stunning. They were beautiful. And it just blew my mind that all these years, the pollution has hidden those mountains from my view. And then I saw some statistics on where the pollution was about a year ago and where it is today. This is as of March, actually. The pollution in LA was cut by 40-50%. It's probably more so in April. And to me, I love if there's a way to somehow remember this as not just the pain of not having economic activity and the threat of the health, but also this is a pretty happy time for me to be home. It's also happy to be able to breathe fresh air, and maybe we can do something to continue this path, because I don't know, I just think this is a pretty special time, that the fact that it's such clean air, you go on the streets, there are not that many cars. It just feels actually really good in that respect. And it's not just us. This is China at the beginning of the year in terms of pollution. And this is only about a month later, and it's remarkable the difference between the two periods. So long story short, maybe one of the things that we'll be able to get out of this is that not only that the economy matters, but we felt really good as people, as human beings, being able to breathe and not stuck in traffic and not having to drive hours to drive this and all the other we have to deal with. So those are that's what I think makes this different, and that's why it's not easy to find periods from which you can draw lessons. But I do think that we can find those, and the lessons are not indicative of like it's a disaster ahead, but rather they're quite hopeful signs.
Yeah, no, that's really helpful. I definitely relate to you on enjoying some parts of this. My kids, I have young kids, 11 and 9, and we've rediscovered, or they've rediscovered getting on their bike and go outside. Ever seeing so many families and so many kids playing outside. It definitely reminds me when I was growing up around the same age back in the 80s. So I definitely agree with a lot of what you're saying. As scary as this is, and the health aspect of it, and of course the market impact. That has been a welcome thing, and as you said, kind of appreciating those basic things that we were too busy to appreciate. So definitely appreciate you sharing that.
I think we're blessed because we do have a way to get food and get electricity and get water and get necessities, and and I'm not sure that if we look back at the other periods, those were as they are today. And even keeping in touch, it's not, I think there are things that we have today that we have to appreciate and put in perspective.
Agreed. So sort of on that same note, you just mentioned kind of the human element. One of the things that I didn't mention in the beginning, Paula, you speak to all kinds of groups, mostly financial advisors, clients of financial advisors. You've spoken to, my guess is dozens of groups in the last couple months with everything going on, especially. What have you found the way, what have you discovered that investors are feeling right now? What are some of the emotions, some of the things they're going through right now?
Well, actually, it's a really important part, Kendall, that you brought up, because it turns out that when you look at not just investing, but you look at life in general, decisions that we make are not always driven by analytics and data, but it's quite often that we make decisions that are rooted with emotion. In fact, come to think about it, the most important decision in our life is who to marry and who to have a family with. And we don't look at numbers and data and evidence. It's all emotions based. So it's not just, it's in everyday life. So we have to pay attention to the emotions. And I got to tell you, there's nothing wrong, but understand how investors feel relative to, is that the best decision that I can make for my money? And what I mean by that, if you look back to, you mentioned the 11 years since the financial crisis, the market has been steadily going up. And what was interesting about those 11 years and what was remarkable is how unremarkable they have been. In other words, we know that there's an element of choppiness in the market, the fluctuation in value. And the last 11 years have been unusually quiet. Think about swimming in a nice warm pond and you go there, oh, it's relaxing and it's warm and it's nice and no waves. And that's the 11 years that we've been through. And yet we know from studying the numbers that the stock market's more of a rougher ocean with waves rather than the small warm pond. So one where we're in this warm pond and all peaceful and that, and the market was inching up, not much to see. Every once in a while, a quick pullback, but nothing crazy. People were very happy to look at their statements, but they're also very interested into buying because everything's going up. Of course, it feels comfortable. Everything looks good. So let's go buy some stocks. And what happened over the past few weeks is we had this big drop, and we went from being too quiet to actually unusually choppy. And not only that people got unhappy looking at their statements, but at the same time, what it did is it allowed some emotions that had not been with us for a long time to resurface. And it went from concern to anxiety, and in some cases, people just became fearful of this market that they couldn't quite make sense of it, and it seemed like a danger zone. There's nothing wrong with fear. Actually, I have to tell you, it's okay to feel the way you do, because that's what makes us human. And fear probably saved our species, because when you're chased by an animal and you're afraid, well, you run, and fleeing saves your life. And it's kind of this idea that now when the market drops, maybe to get out of the danger zone, I might need to flee the market and sell. So what I'm trying to tell you is that the emotions do play a part into what we do. And I've seen more and more of these emotions resurfacing, people feeling a little anxious and saying, maybe it's a good time for me to sell. And the reason I bring this up is that if you think of the rational aspect of investing, well, what you should do is fundamentally at a very simplistic level, which is still the best way to go, is buy low, sell high. Nothing too complicated. Buy low, sell high, make money, and that's successful investing. But think about what emotional investing is asking you to do. Let's go ahead and buy on the way up, and let's sell on the way down. So analytical investor, buy low, sell high. An emotional one tends to sell low and buy high, which is exactly the opposite. So to me, we have to pay attention, not because there's something wrong. It's just the awareness of is this an emotional decision or a rational analytical decision? And I got to tell you, it's okay to feel the way you do. But my suggestion is to disentangle emotions from investment decisions. Pay attention to these emotions, but do not make investment decisions that are clouded with emotion. And that's what I've seen a lot more lately, is these emotions resurfacing, and some people considering actions that are more rooted in emotion than logic and analytics.
That's and I agree with you from the clients I'm able to work with. That generally, the more we can get them focused on their goals, staying disciplined, like you said, acknowledging the fears. I always say, if you didn't have any fear, we'd have to make sure you're human.
Yeah, exactly.
So totally agree with what you said. And I really appreciate how you simplified that for us. Maybe kind of pivoting for a second from, although emotions continue to be an important driver, maybe the most important driver of what's going on out there. Are there some, you'd already brought up three past lessons that were really, really helpful based on kind of what we're going through with the supply and challenges. What about other historical volatility? One of the things that's happened the last 2 months is we've seen some historic down days. We've seen some historic up days. I've seen where I think the S&P is down about 34% from peak to trough, and it got down 20% faster than any time in the history. So are there some lessons that we can learn from past periods of extreme volatility?
Yeah, and you're right. I mean, if you look at March, well, let me first of all kind of build up on the idea that you just mentioned is on the choppiness on this, basically this cycle that you mentioned. It used to be months or weeks before we saw these movements up and down, but this cycle of emotion is now almost on a daily basis, because what you just said, it's so true. You have a headline and all of a sudden the Dow is down 3,000 points. And you look at this headline, it's like, oh boy, this is not good. And then just a couple of days later, wait a second, it's actually the best day in the last 80 years in the market. And then you have something happen with the oil, and then about a few days later, something happens with the Fed, and the market goes up. So this roller coaster of emotions has been more extreme than usual. And to really see this, I'll just give you a quick statistic. Whether you look at March, or whether you look at 2020 as a whole, what you see is something quite interesting, that approximately half of all trading day, the market went up, and about half of the days the market went down. So it's a pretty even split between the markets going up or down. And what you see is that in March alone, you had 6 days when the market went up by 4% or more, but there are also 6 days when it went -4 and below. So it's been very choppy, but it's a pretty even split on a day-to-day basis between good days and bad days. Now, how different is this from historical? Like if you look at 2019, 2018, 2017 on a daily basis, how is that different? Well, it turns out that not vastly. If you look on a daily basis in the US stock market, going back 5, 10, 15 years, it's roughly the same. About 53% of all trading days in the market, they're positive, so the market goes up. 47%, they're negative. So if you watch the market on a daily basis, whether it's in March or for the past few years, it's pretty much the same. Flip of a coin. Watching the market on a daily basis is not very productive, because think of, let's say that Kendall, you plan on being in your house for 15 years, and somebody comes to your door tomorrow and says, Kendall, good news, your house is up 10% today. And you're like, okay. And then come back the day after and say, well, bad news is down 25% today. And you're like, I don't care. I'm going to be in my house for 15 years. What do I care the value today or tomorrow? And that's kind of with the market. Your stock portfolio is not for the next week or month or even a year. It's for a longer term. And the more you can switch your perspective from the daily, let's say, to the monthly, what you see is that on a monthly basis, instead of 53, about 63% of all months in the market are positive and only 37% negative. So all of a sudden, you're more likely to see a good month than a bad month. And if you can go even to a year, it's even better. 3 and 4 years, the market has gone up, roughly speaking, and 1 in 4 has gone down. So it's a matter of getting the appropriate time horizon for your investments. Now, if you do want to know what happened historically, when we had this 20% downturn, it has been a history of ups and downs. In other words, there's nothing really unusual in the fact that we have a sequence of bull and bear markets. I think you made the point that we've had 11 years of a bull market. That's sort of the average that we see, so not vastly different. And you can see visually all the bull years, they tend to be a lot longer than the bear markets, but there certainly have been bear markets, and it's hard to predict. Sometimes they're farther apart and sometimes they're close together. It's hard to predict, but we do know they happen, these 20% drops, so it's not terribly unusual. So in that respect, it's not frequent, but it's not terribly unusual. Probably 1 in every 10, 15 years, we see something of this magnitude. What's interesting is what happens afterwards. So when you fast forward a year after the market dropped and you ask, okay, well, what has the market done historically on an average per year? What you find is that the average growth of the U.S. stock market per year has been roughly 9 to 10%. And if you look at a 20% market decline, and you see after these periods when we saw a decline of 20%, what happened on average afterwards? Well, average after the market dropped 1 year later, on average, you see that the market went up by about 14%, which is way above the historical average. And that is sustained over 3 years and over 5 years on average per year. So I guess what this really like the message is that we see the market downturn, and anytime we saw a 20% decline and then we saw what happened afterwards, on average, you saw that the growth was higher than the long-term trend. So it doesn't indicate that historically we saw more pain after a 20% drop, but rather there was a pretty nice rebound over 1, 3, or 5 years.
No, that's great. That's great data and reassuring data. One of the things that we hear quite a bit from clients and people is, I think I want to wait and see things stabilize. You hear the news of unemployment's going to be double digits, maybe above 20%. Companies are going to lose a lot of money. We're going to have horrible economic news. Somehow the market has had some recovery. We're still not to where we were earlier in the year, but what are we to make of that? We see it's coming. So when an investor asks, "Hey, why don't I just step out for things get better?" What would you say to someone who's kind of trying to take that wait and see approach?
I mean, my first thing of that, I would tell that person that honest, I can't understand how everybody feels about it, but it seems to me that that person might be at a point in their life when either they need more stability, they can look their statements and see it drop and maybe they get close to retirement, or maybe that they don't have the risk capacity to handle the movements in the market. So what I would tell that person is that it is understandable that you don't want to lose money, because nobody wants to lose money. Nobody does it. And there are different ways in we can accomplish that. And one of them is what they're thinking is that let's sell. And if we sell, we have the money on the sidelines and we're not going to lose anymore. So that's the really good news. And that would give them some comfort. So I acknowledge that's a strategy that's certainly appealing. I've tried it years and years ago. I've talked to countless investors. I've studied numbers, and I've also spoke to many investors just like that individual who have done it. And I've come to realize that there are some considerations as you're trying to do something like this. And the first consideration is that if you decide to sell, there's an equally important have to make at exactly the same time, which is when do you get back in the market? You do have to decide that, because if you think 23,000 is too high for the Dow, well, what's the right number? Is it 21, 20, 19? What if it never gets there? That's what happened to me. So you have to make a decision because it is really important to know, when do I get back in? And if you wait and say, I'll wait for the storm to pass, I'll wait for things to calm down and return to normal, it is very likely that by the time that happens, the market would have already gone back up. And I'll give you an example. 2008 and 9, Kendall brought that up. In 2008, it was a terrible year for the market, and economically, you can see that the brunt was about to come. And there's no doubt 2009 was the worst economic year of the financial downturn. Unemployment was high, output was low. It was a terrible year from an economy perspective. So if you're at the beginning of 2009 and you're saying the economy really in bad shape, you're absolutely right. It was a terrible year for the economy, worst year of the recession. And what's interesting is that the same year was remarkably good for the stock markets. We know the average is 9-10%. That year, the U.S. stock market went up over 25%. So by the time the smoke cleared, you say, well, things look good. Let me back in the market. What you've basically done is you've taken something that could have been a temporary paper loss and just turn it into a permanent loss, because you'll never be able to recover. You missed the big upswing in the market. So to me, it's intuitively appealing, and unless you can make these correct calls, I think that you're more likely to get hurt than protect yourself. And there's one more thing that I learned from my own. When I sold, I thought that I would eliminate the stress of being invested in the market. And what I found is that not quite, because the stress of being in the market was very quickly replaced by the stress of being out of the market. I'm looking at the market bouncing back, like as you pointed out, from the -30 to whatever, -15 or so. And you're sitting there kind of like wondering, whoa, I'm missing all this. When do I get back in? And that stress was to me as equally as intense as being invested. So I looked at that. In my personal opinion, it is not something that would really help investors, but because you can't control the markets, nobody can. But what you can do is apply some strategies that would enable you to focus on things that you can actually control as an investor. If you look at the stock market, is basically buying ownership into companies, and as I said, historically has been 9 to 10% per year. And the value of the ownership, the value of the stock market, is derived from the profits that I expect to receive if I become a part owner in that company. And profits fluctuate, and so does the stock market. So there's really a great deal of fluctuation in the market, and that is something to be expected. That the markets will fluctuate because profits fluctuate. But historically has been a pretty nice growth. In fact, it looks a little bit like a roller coaster ride, and it is. It is a roller coaster ride, and even your stomach might be turning. You're better off staying in your seat rather than trying to jump out in the middle of it. But it's been a very rewarding ride. It's funny. We have a book called The Matrix Book that I kind of always have next to me, and it's a phenomenal book. It's an encyclopedia of numbers, a big book of numbers, and it shows that we started to have really good data on the U.S. market, the S&P 500, back in 1926. That's when my dad is born, and I wonder, what if my grandparents had put $1 into the U.S. market and left it alone through the Depression, the good times, bad times, the Roaring '20s, the wars, the good, all the times. What would they have grown to in my dad's lifetime by the time he turned 92? He's 93 today, and it turns out that $1 in my dad's lifetime would have grown to about $7,000. It's a really nice growth, 7,000 fold. I wish my grandparents had put $100 in there. But what if you don't want to take all the choppiness? What can you do? It turns out there's something else that Castleview and Kendall can do, and that's what Dimensional kind of works for them, which is not only buying ownership in companies, but also lending your money to corporations and the government. There's a contract in place that specifies an interest rate that you will receive. It's an interest rate that's spelled out in the contract for a specified period of time, and at the end, you get your money back. That is called a bond. And if you deal with a trustee issuer, and the U.S. government has never missed an interest payment or a principal repayment, and if you do it for a short term, let's say 30 days, give them the money, they give you back the money plus interest. This is called a 30-day treasury bill. Over the 93 years that we have good data, that has never been a calendar year when you open your statement and you see, boy, I don't have as much money. I lost money. Never. It's never had a negative year, a lot less fluctuation than the stock market, and you did get to earn a little bit above inflation. The historical inflation in the U.S. has been 3%. This earned you just a little above that. Interest rates are lower today, and so is inflation. But over the long run, you did get the inflation. So if you want some stability in your money, one of the things that Castleview and Kendall can do is balance a little bit how much they put in stocks and how much they put in bonds. But there's a trade-off, because you don't make 9-10%, you make 3 to 4% per year. So just to kind of ask you, knowing that if you grow $1 at 9-10%, it would be 7,000. If you grow at 3-4%, what would the 7,000 become? What's the number? And once again, the book has the answer. And if you grow the same dollar over the same time frame at 3-4% rather than 9-10%, the answer is that you'll be growing to a whopping $21. And it's not missing any zeros, $21. So it's a very big trade-off between stocks and bonds. But you do get a lot of stability from bonds. And even this year, there are government bonds. They're up almost 9-10%. There are others that are up 1-2%. So they are holding up really well in times of crisis. It's just you need to find the right balance. And how do you know it? Well, there is no magic number. There's nothing that you can say, well, tell me what is the exact precise. The way to know this is to sit down with the Castleview and team and the Kendall and really come up with a financial plan that takes account of your personal circumstances, such as your age, the type of job you have, what are the financial assets you have, do you have a pension or not, when do you need the money, how much money do you need to get, what is your risk capacity. And when you put all of these together into this financial plan, only then an advisor can determine the appropriate balance between stocks and bonds for your circumstances, not anything generic. So you need to sit down and find this. And if you get close to retirement, there's a good chance that you might not be invested in the stock market as much as you think. You might actually have some money in bonds to cushion against market downturns. So that's the very first way that you can do that. The second thing that you can do is not put all the money only in U.S. companies. It turns out that if you redraw a world map, that instead of landmass, you were to plot the value of all companies that you can buy and sell in different countries of the world, this is what the map would look like. The U.S. has about 3,000 different companies, Apple, Google, Microsoft, Exxon, all these companies that we know and love that are part of the U.S. stock market, and they amount to about 54% of the value of all stocks in the world. But there are 9,000 plus other companies in 40 other stock markets, and it turns out that it is actually quite good to invest not only in the U.S. but around the world, because there are times when the U.S. is doing well, like the last decade, and there are times when the other countries are doing well, like it was the case in the previous decade. So it cushions the blow of just one country. And the last thing you can do is not, the last thing you can do is basically, before something happens, put a plan in motion and execute it when something happens like this downturn. In other words, it's like I live in Los Angeles. I know at some point there'll be an earthquake. And what I like to do is kind of have a plan in place of what will I do when that happens, not make decisions on the fly, particularly when things are emotional. And it's exactly the same with Castleview. Before this happened, they said, okay, when the market drops, what will we do? And it turns out that if you have a certain balance between stocks and bonds, and stocks have dropped and maybe the bonds have gone up a bit, well, instead of thinking about selling further stocks, what you might want to think about doing is trimming the gains, putting some money that used to be in bonds into stocks so you can come back to the right level between stocks and bonds. But do this a predetermined plan that takes away emotion, and it was established before all of this. This is called rebalancing. And I think rebalancing is a huge benefit to investors, because when the market rebounds, if you're too light on stocks, you're never going to be able to catch up. And that's what we saw in 08 or 09, this rebalancing really helping investors. But it also helps you the other way. For the 10, 11 years when the market kept going up, rebalancing also says that if the stocks go up, no, you got to trim them, sell high, and then go buy bonds so you can have the same balance in your portfolio. And that is something that has to be done carefully and very customized to each one of you. And I know that advisors every day, they're making decisions, and most better decisions most days not to trade, but it's something that you want to look at every day, and then you decide when you want to do it at what interval. But it's a very custom decision. And to me, bonds, international stocks, and this predetermined process, rebalancing, and sometimes taking advantage from a tax perspective, there's something called tax loss harvesting that might make sense for some. It's a better way to mitigate a downturn than to try to get out. This is a very long-winded answer to your question.
No, it's perfect, and it's it's great because it's aligned with what we've been doing, and similar to what you said, we were prepared for the time when a market downturn was coming. We didn't know when it was coming. We knew it was going to come. We just didn't know when, and that was something that was reassuring to us as advisors, and I believe and hope reassuring to our clients, is that we planned for these things. We had these things in mind when we designed their portfolio. And I love how you said, this is something I invest over here or there. You said it's always about starting with a plan. Everyone's different. Everyone's unique. And to your point about the things you can do, amid this, the rebalancing, the tax loss harvesting, and we like to say sort of what you said. If you're holding a certain number of stocks on the way down, you want to make sure you balance on the way up so you get all the return, and the same on the other end. When stocks are going up, we're rebalancing when they get a little too high. And it's counterintuitive to those emotions that you referenced. But that's what we always tell people, like you said, this is the plan. We're going to stay disciplined. And unless things change in your plan, what you just told us, Apollo, we wholeheartedly agree. One of the things I wanted to get to before we get to the end of this is we live in Oklahoma. We have a lot of clients that are in Texas as well. So a good number of the people on this webinar are especially interested in what's going on the crude oil and another historic day yesterday.
Yes,
so I guess my question for you is not so much to understand exactly how that happened as much as it is to say, how should we as investors think about that in our portfolio? We hold some energy companies, but obviously we hold a lot of other industries. So what would be your thoughts and perspective on how that might impact us?
I mean, first of all, my hearts go out because I know, with the negative price and also the fact that there's certain costs out, there's certain debts they have to pay, and it's sad that in some ways your destiny, your livelihood in Oklahoma and Texas and all these parts of the country, particularly for the smaller firms, are tied to events that you can't control. Like I remember listening about that meeting in Vienna a month ago on the Russians and the South, and their little whatever that was ended up impacting negatively so many of you. I really, it's just my hearts go out, and I know there are a lot of hardworking folks. From an investment, I think that what we find is invariably that investors, to some degree, should consider as part of the financial plan that we talked about their comprehensive wealth. In other words, I'll give you two examples of how you can think about this. If you are business owners, and so many folks we work with are business owners, small business owners, and you look at that, well, that owns basically what's called equity, and it's not unlike owning equity in the stock market, owning stocks in the market. So when you look comprehensively at your wealth and you see that, boy, I have a big piece of equity through my company, through what I hold, I also want to be careful that I balance that out with enough bonds, because the equity comes from both my business and the stock market. And secondly, I think that what you want to do is say, if my income is tightly generated to an industry, what I want to do in my portfolio is make sure that I'm not overly exposed to the same industry. And I think that the way that Castleview does it, and Kendall, which has a much broader diversified perspective, that is actually a good thing. If you look at the big holdings that are in the U.S. market, if you are comprehensively invested, it is an Amazon who's been doing quite well. It is not just energy. So I think that to some degree, the more you can diversify away your investments from the type of business and the type of job from which you earn the regular paycheck, I think the better off you will be. And it was a bit of lesson that everybody learned years ago when Enron went under, and so many people had their savings in the 401k invested in the Exxon stock. So not only they were getting the paycheck from Exxon, but their investments were also in Exxon. And a lot of people realize that, boy, I should maybe kind of pay attention that I don't get, I don't invest in kind of the same type of company or sector as where my paycheck comes from. So I think it's ultimately there are things that you can control, because some of these things will happen outside of your control when it comes to the oil and gas. The one thing you can do is further adjust the balance between stocks and bonds. And within stocks, make sure that you have good exposure to companies all over the world, and not emphasize too much the sector from which you earn your living.
Yeah, no, that's helpful. And really just kind of one more question before we wrap up, which is related to that. Crude oil went to zero and then actually went to negative territory. What is your perspective when you hear people worry about the markets meaning the stock market, going to zero, especially in a diversified portfolio like you showed earlier. Concerned about?
The stock market. So let's demystify quickly the stock market. The stock market represents all the companies that you can buy and sell. And in the US, that typically is denoted either as Dow Jones or the S&P 500. What's the difference? The Dow Jones is a group of 30 companies out of the 3,000 that are large, established, mature companies, but they're 30 out of 3,000. S&P is, and by the way, Amazon is not part of the Dow. So S&P is used by professional Moors to define what the market is. So what would it mean that the market, either Dow Jones or the S&P, or the broad number of 3,000 companies in the US, what does it mean that it goes to zero if you're fully diversified, like Castleview is? Well, what it means that all of these companies would have to disappear all at the same time. And you take a step further and say, can I lose all my money if I'm in a globally diversified portfolio? Well, right now you own about 12,000 companies in 40 different countries with the strategy. So what would it mean for 40 different countries, 12,000 different companies, every single meaningful company in the world to disappear at exactly the same time? Well, not only it's unlikely, if